Okay, perfect. So today I want us to talk about International Financial Reporting Style number 15. I want us to talk about International Financial Reporting Style number 15. Okay. International Financial Reporting Style number 15 is basically telling us about revenue from contracts with customers. Okay. Revenue from contracts with customers. So what we are going to do is we'll basically break it down so that we understand all the terms that are used, the terminologies that is used under International Financial Reporting Standard number 15, what it is all about, what a contract is, who a customer is, and also the recognition and the measurement. And then afterwards, we'll compare it to a question. Okay? Right. So, International Financial Reporting Standard number 15 is actually very detailed, although I've noticed during the exam, questions come straightforward. Sometimes they can just bring revenue, they can say, oh, this is the revenue. Or sometimes they can just try to make it slightly tricky, but in most cases, everything just comes straightforward. But still, there's need for us to understand International Financial Reporting Standard number 15. Okay, so what is International Financial Reporting Standard number 15? So International Financial Reporting Standard number 15 is actually an international accounting standard that governs how businesses recognize and report revenue from contracts with their customers. It ensures that the revenue is recognized in a way that reflects the transfer of goods or services and also aligns with the business's performance obligations. Okay? So there are probably new terms here that I'm assuming are new. For instance, there's this word here, obligation. Performance obligation. Let me just repeat what International Financial Reporting Standard number 15 is all about. So we know it's a standard that actually governs how a business will recognize and report its revenue or its sales from contracts with its customers, so as to ensure that revenue is recognized in a way that reflects the transfer of goods or services, and also it makes sure that the revenue aligns with the business's performance obligations. Okay, so we have terms we're supposed to understand. Remember when I said we need to understand the terminology? Apart from the computation, we are also supposed to understand the terminology. So we need to understand the terminologies, and then we need to understand the computations, we need to understand the measurement and the recognition in different scenarios. And also bring up some different questions afterwards, and then we'll try to answer them. Yeah, to see if we understand what International Financial Reporting Standard 15 is all about. Okay, so in terms of terminologies that we're supposed to understand, we have performance obligation itself. We have revenue. We need to understand what revenue is. We have a contract. What is a contract? We need to understand what a contract is. We need to understand terms like a transaction price. A transaction price. We need to understand terms like let's say contract assets or contract liabilities, but my main focus will basically be on these four: the performance obligation, the revenue, the contract, and the transaction price. The other ones I'll probably just explain them a bit, but my main focus will be on these four because they're the main ones. Okay, so let's start with revenue itself. We'll start with revenue. What is revenue? So revenue, this is the income that is earned from selling goods, or maybe us providing a service as part of our business's ordinary activity. Okay, or us basically getting income from our operating activities. Let's say we are selling a service or we are selling a product. What we get will be our revenue, or will be our sales revenue, or will be our sales, or will be our turnover. We use different terminologies, but it's still the same. Okay. How about contract? What is a contract? So, a contract is basically an agreement between two or more people or two or more parties who have actually agreed to enforce rights and obligations. Okay, so a contract is an agreement, not this word, an agreement between two or more parties who have agreed to create enforceable rights and obligations. Like for instance, let's say we bring an example. We have two people. We have a customer and we have a supplier. The customer wants 200 bags of cement at 150 kwacha one. That's 150 times 200. That's about 30,000 kwacha. So a customer wants 200 bags of cement from a supplier at 150 kwacha. We know the total selling price is 30,000. By the way, the 30,000 will be our transaction price. Okay? The transaction price, that's the amount of money an entity expects to receive for transferring goods or services. So in this example or in this scenario, the 30,000 kwacha represent the transaction price. Okay? So we have two people here, there. We have a customer who wants to buy the cement, and we have a supplier who wants to sell the cement. So those two people have agreed. So the agreement is actually a contract. Okay, the agreement between the two parties, the customer and the supplier, to actually deliver those goods and receive a transactional price is a contract. It's a contract of sale. Okay, so we have one more term here that we need to understand, which is performance obligation. What is performance obligation? So performance obligation is a promise in a contract to deliver a distinct good or service to a customer. Okay, it's a promise in a contract to deliver goods or services to a customer. There's something that I want to note about performance obligation. I'll give you an example. Let me just give you a rough example. Let's say we have, let's imagine this is January. Okay, this transaction is happening in January. The customer actually pays us the 30,000 kwacha for 200 bags of cement at 150 kwacha each. But we only give them the goods in November because maybe we didn't have stock, or for some reason, or maybe, I don't know, for some inefficiency reason, we practically just delayed. So the customer has paid us 30,000 kwacha in January for 200 bags of cement, and we've given the cement to the customer in November. What does this mean? We have fulfilled our performance obligation in November. So according to International Financial Reporting Standard number 15, for as long as the performance obligation is not met, that sale will not be recognized as revenue. So like in this example, we got the 30,000 kwacha for 200 bags of cement in January, but we only recognize our sale in November, because that's when we actually fulfilled our performance obligation. So our income statement will have 30,000 cash sales in November. Let me repeat, our income statement will have 30,000 kwacha worth of cash sales in November. In January, our bank statement will have 30,000 kwacha. It will just be a receipt. It will affect our balance sheet in that it will be a current asset. Okay, because we have actually received money, so it will be a current asset, but it won't really affect our income statement or our profitability. Okay, so now that we understand what performance obligation is, what revenue is, what contract is, and what transaction price is, so there are also some other terminologies that you're supposed to understand. For instance, we can talk about terms like variable consideration, which is the part of the transaction price that may vary due to discounts, refunds, or incentives, or basically penalties. We can talk about control, the ability of the customer to direct the use of an asset and obtain its benefits. We can also talk about things like the contract asset and the contract liability. A contract asset is a right to consideration for goods or services transferred before receiving payment. Okay, a contract asset is a right to consideration for goods or services transferred before receiving payment. And then a contract liability is basically the opposite. Okay, now let's talk about measurement. How do we measure and recognize International Financial Reporting Standard number 15, which talks about revenue from contracts with customers? How do we do it? Okay, so number one, we'll start with the recognition. Number one, we'll start with the recognition. So in terms of the recognition of revenue, we use what we call the 5-step model. Okay, or basically I use what I call the 5-step model to actually recognize my revenue. Okay, number one, I'll identify the contract with a customer. Okay, number one, I'll identify the contract with a customer. So recognition, I'll just list the steps. Number one, we identify the contract with the customer. So number one, we identify the contract with the customer. Number two, we identify the performance obligation. Okay, by the way, it's the performance obligation in the contract. Okay, we identify the contract with the customer, then recognition. Number two, the step, we identify the performance obligation in the contract. Number three, we determine the transactional price. Number three, we determine the transactional price. And then number four, we basically link our second step and our third step. So what we're going to do is we'll allocate our transactional price to the performance obligation. So allocate the transaction price to the performance obligation. So I'll actually explain these. Let me just write the fifth one as well. The number five, we recognize the revenue now. Okay, so number one, we identify the contract with the customer. Number two, we identify the performance. This is supposed to be performance. Number two, we identify the performance obligation. Yeah. Number two, we identify the performance obligation. So number one, identify the contract with the customer. Number two, I identify the performance obligation in the contract. Number three, determine the transaction price. Number four, allocate the transaction price to the performance obligation. And number five, recognize revenue when a business satisfies a performance obligation. Okay, let me break this down. Okay. Let me break this down. So what we're going to do is we're going to, do you remember our example where we were talking about 200 bags of cement at 150 kwacha, which was paid for in January, but the goods were only received by the customer in November. Okay, let us relate these steps of recognition to that particular example. So let's link the two. Okay, so the first one says we identify the contract with the customer. We identify the contract with the customer. So by identifying the contract with the customer, what are we doing? So what we are doing is, firstly, we have to check if the contract is legally enforceable and it contains substantial or commercial substance. Also, we have to ensure that both parties actually approved and commit to fulfilling the obligations pertaining to that contract. Like it's a contract, it's an agreement, so we have to make sure that it's a literal agreement between two people. They both agree, okay, to fulfill the obligation or to make whatever payments they're supposed to make. They both agree to that. So we just have to ensure. So that's identify the contract with the customer. Number two, we identify the performance obligation in the contract. Okay. So a contract may have multiple performance obligations. Um, it can be a goods, maybe we are giving, it might be a product, maybe we are selling a product, and us giving that customer our product is our performance obligation, or it might be a service, us providing that service is our performance obligation. I'll give an example. Like in our example, where we're talking about 10 bags of cement, 200 bags of cement at 150 kwacha, the performance obligation is us giving our customer 200 bags of cement because they have already done their part, they have already paid. So in our example, we have identified what the performance obligation is in our contract example. Okay, and then number three, determine the transaction price. So number three, determine the transaction price. This one is actually very straightforward. So by the transaction price, we are looking at the consideration that the company is expecting to receive and also the customer is expecting to pay. That's the transactional price for that particular transaction or for that particular contract. Or basically the price at which the customer is paying for their performance obligation. Okay. Number five, recognize revenue when a business satisfies the performance obligation. Okay, this is very good. So the thing is, in our example, we said we paid for cement in January, 200 bags at 150 kwacha. Total will be 30,000 kwacha. And then we only got this revenue, we only got the cement in November. So according to International Financial Reporting Standard number 15, we are only supposed to recognize the revenue in November when we actually fulfill our performance obligation. Recognize revenue when a business satisfies a performance obligation. Okay. So basically, for us to recognize revenue, we can use these particular steps. Number one, we identify the contract with the customer. Number two, we identify the performance obligation in the contract. Number three, we determine the transactional price. Number four, we allocate the transactional price, the performance obligation. And number five, we recognize revenue when a business satisfies a performance obligation. Okay. So let's say we bring in an example. Okay. Let's say we bring in an example. Let's say a retail business sells a laptop for 10,000 kwacha, and then the customer pays immediately and takes the laptop. Okay. Hello, Doris.
Hello. Yes.
Yeah. Yeah. Have you heard the question? Let's say a retail business sells a laptop for 10,000 kwacha, and then the customer pays immediately and takes the laptop. According to the International Financial Reporting Standard 15, when are we supposed to recognize the revenue?
Then because the what one they've satisfied the performance obligation, the customer has gotten the what the goods, the laptop.
Okay. Here's another question. An IT company provides a 12-month software maintenance contract for 24,000 kwacha. So we have an IT company is providing a service 12 24,000 kwacha worth for 12 months. That's a software maintenance service. Okay, so we have a 24,000 kwacha for 12 months. How are we going to recognize our revenue according to International Accounting Standard, International Financial Reporting Standard number 15?
Mm, I think we'll be recognizing it every month. Like we divide, like we allocate the transaction price to the performance obligation first, because it
Yeah.
will, for it to cater all the months.
Okay. Yeah. That's actually correct. So what we do is we'll do exactly that. We'll apportion the 24,000 kwacha amongst 12 months. So it will be 2,000 kwacha for each month because we divide the 24,000 kwacha by the 12. Okay, here's another question. A construction company builds a 5 million kwacha shopping mall over 2 years.
Repeat the question again.
A construction company builds a 5 million shopping mall over 2 years. A construction company builds builds a 5 million kwacha shopping mall over 2 years. How do you recognize the revenue?
Mm, I think we'll still do the same.
Yeah, it's actually similar because we recognize the revenue gradually as construction progresses based on the
Yes.
work that they have completed.
Mm,
Okay. So basically that's a summary of International Accounting Standard, International Financial Reporting Standard number number 15. Okay, International Financial Reporting Standard number 15, which talks about revenue from contract with customers. So now we are familiar with whatever terms we're supposed to understand, the performance obligations, the revenue, the contracts, and the transaction price. Okay, so like I mentioned when we were starting this recording, that we actually solve a portion of a question and explain how it will affect the entire question from a Zika past paper. That's what we're going to do. So we have a question right here, question number 2. Chiseka Limited is a beverage manufacturer for a drink called Yo-Yo Cool. So what we're going to do is we just have a portion that relates to revenue. Okay. So like I mentioned, revenue is actually very detailed. Okay, it's very detailed. It talks about the same performance obligations and everything else. It's actually a lot of things that are pertaining to revenue. But like I also mentioned when I was starting this video, uh, Zika questions are usually straightforward. They're not always complicated. They'll just give you a question. Like for instance, they'll give you a trial balance on the services revenue. Like for instance, we have a trial balance here, and in this particular trial balance, we have revenue somewhere. We have revenue here, revenue of 290,750 kwacha as our revenue. So what we're going to do is we'll only account for this revenue and we'll explain how this revenue will affect our financials. What do I mean by financials? I'm talking about if it will affect our balance sheet, if it will affect our cash flow, if it will affect our equity, or if it will affect our income statement. Okay, if it won't affect any of this, it's cool. But at least we have to mention what it's going to affect and how it will affect it. Perfect. Cool. We should do that.
yes.
Okay, so I won't read everything because I'm mainly concentrating on revenue. So we have revenue here in the saying note 1 of 290,750. So additional information provided is as follows. Roman numeral number 1, they're saying included in revenue is 22.5 million cash sales. Okay, included in revenue is 22.5 million cash sales made by Chiseka Limited or acting as an agent for Quenchio. The agency agreement provides for a 12% of the sales as commission to Chiseka Limited. By 31 March 2021, Chiseka Limited had remitted to Quenchio 19.8 million included in cost of sales. Okay,
Yeah.
let me repeat again. Included in revenue is 22.5 million kwacha cash. Included in revenue is 22.5 million kwacha cash sales made by Chiseka Limited while acting as an agent for Quenchio. The agency agreement provides for a 12% of the sales as commission to Chiseka Limited. Okay, so we have a sales commission right here. How do we treat a sales commission? A sales commission is a variable cost. It's a direct cost. Okay,
Okay.
a sales commission is a variable cost. It's a marginal cost or it's a direct cost. Remember when we are doing costing or when we are basically explaining some management accounting terms, you find that we treat a sales commission as a variable cost because it is a variable cost. It is affected by sales production or by sales volume. So in
Mm.
our income statement, our sales commission will be,
It will be
okay,
12% of everything.
yeah, so our sales commission will be 12% of the cash sales that the agency was directly involved in. Okay, so in this particular question, firstly, we have to determine the sales commission. Okay, so according to that, firstly, we have revenue. Let me just make like data. We have revenue of 297.50. I actually remember saying that so many times. 297.50. So we have 290,750. This, okay. So that's our revenue. So we have revenue of 290,750. And what are they telling us about the same revenue? So what they are telling us is included in the revenue is 22.5 million. Okay, so included in that same revenue is 22.5 million. Okay, perfect. Million cash sales made by Chiseka Limited while acting as an agent for Quenchio. The agency agreement provides for a 12% of the sales as commission to Chiseka. Okay, so let us find our sales commission. Our sales commission is, we have 22,500 times 12%, which will be 2,700 as our sales commission. And then we have cash sales of 22,500. Okay, so we have cash sales of 22,500 and we have a sales commission of 2,700. So how is this going to affect our statement or our financials? Firstly, our sales figure will reduce. Okay, firstly, our sales figure will actually reduce. Instead of it being our cash sales, instead of being 22,500, we'll remove our sales commission. We'll remove our sales commission of
Of
2,700. We'll remove our sales commission, so our total will be, okay, 19,800 as our net cash sales. Okay, what are they telling us again? Included in revenue is 22,500,000 cash sales made by Chiseka Limited while acting as an agent for Quenchio. The agency agreement provides for a 12% of the sales as commission to Chiseka Limited. By 31 March 2021, Chiseka Limited had remitted to Quenchio 19,800 million included in cost of sales. Okay, by 31 March 2021, Chiseka Limited had remitted to Quenchio 19.8 million. Let's see, Chiseka Limited. Okay, so Chiseka Limited actually gave Quenchio 19.8 million only, which is included in cost of sales. Okay, so now what we want to find is our revenue. Okay, so they remitted 19.8, so they basically more like got their commission already. Okay, so the total
yes.
cash sales, net cash sales, Okay,
Mm-hmm.
the net cash sales will be 19,800. So we have 2000. It was 22,500 in terms of cash sales. Sales commission 2,700, and the net cash sales is 19,800.
Yes.
Okay, and what are they telling us? They are saying the 19.8 million, which is the 19,800 that we have in our data, is actually included in the cost of sales. Okay,
Okay.
okay. So the 19.8 million is actually already included in the cost of sales, and then included in revenue is okay. So what we are going to do, how we are going to do it is that we have two separate accounts here. Okay, we have the cost of sales. Okay, we have the
Yes.
cost of sale account. Let me just do my debits and credits. So we have debit here and we have credit here. So we have the cost of sales and we have the revenue. So how is this 19.8 going to affect? So what they're telling us, they're saying the 19.8 is actually included in cost of sales. Okay?
Yes. So it's going to
So
be
what they're
credited.
telling us, yeah, so we're going to credit it. It's going to be 19.8 here. Okay? Yeah,
Yes.
it's going to be, we're going to credit the 19,800 in our cost of sales. And then to revenue, because we've actually credited it to cost of sales, meaning it will be debited to revenue.
Yes.
Okay? The,
Yeah.
the, 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 the comparison is, yeah, credited and then debited to revenue. So if we were to do this and we want to actually compute our total revenue, since we're actually debiting 19,800 and we know that revenue is initially a credit, that's a credit and a debit, meaning our final balance will be a reduction. Okay? So it will be
Mm-hmm.
290 minus 19,800 as our revenue. So our revenue figure will be 270,950. Okay? So revenue will be 2,900, will be 270,950 kwacha. So this is what we are going to have in our income statement. Okay?
Oh yeah.
Yeah, as per the information that they've given us. So we've actually solved a part of a Zika question. Okay, we've actually solved a part of a Zika question, which is basically talking about revenue. Okay, otherwise that's that. Okay, so Doris, thank you very much for being part of the session.
Thank you